The warning. Before the fall. People often believe disasters arrive without warning, that they strike suddenly, without signs. But the truth about the 1929 stock market crash is far more disturbing. The collapse was not a surprise. It was visible years in advance to anyone willing to look closely. Throughout the 1920s, the stock market seemed to move in only one direction: up. Prices rose so consistently that doubt itself began to feel irrational. Those who questioned the market were mocked, ignored, or pushed aside. Belief replaced analysis. Confidence replaced caution. This was the moment the system began to rot from the inside. When an entire society accepts the idea that prices can only rise, risk disappears from public imagination. And once risk is forgotten, disaster becomes inevitable. Speculation takes control. While real productivity existed, speculation grew faster. By the late 1920s, the stock market became a national obsession. Investing turned into gambling. Millions of Americans rushed into stocks, not because they understood businesses, but because prices kept rising. The market stopped being a place to build wealth slowly. It became a machine for fast money. Everyone joins the game. Clerks, tailors, shop owners, and factory workers entered the market. They didn't analyze balance sheets. They didn't study companies. They believed prices would be higher tomorrow. Each new buyer pushed prices higher, confirming the belief. The cycle fed itself. Confidence became the fuel. The trap of margin trading. Most people were not buying stocks with their own money. They were borrowing. Margin trading allowed investors to put down as little as 10% and borrow the rest from brokers. As long as prices rose, profits looked effortless. But leverage magnified losses as easily as gains. It was a system that worked only while prices climbed. And once prices stopped rising, it would destroy everything. The Roaring Twenties lifestyle. The 1920s became an era of celebration. Jazz music filled clubs. Cars rolled off assembly lines. Consumer goods flooded the market. Thanks to mass production, ordinary families could suddenly afford automobiles, radios, and household appliances. The American dream evolved. It was no longer just about stability. It became about constant improvement, constant consumption, and constant growth. People believed the future would always be better than the present. This belief would prove fatal. Black Monday. On October 28th, prices collapsed. Fortunes vanished. Debt replaced wealth. Confidence shattered. Those who bought on margin didn't just lose money. They owed money. The lesson of 1929. The disaster was predictable. Warnings existed. Incentives silenced them. Markets built on belief instead of reality always collapse. History remembers 1929 as a warning. The question is, do we listen? America's post-war advantage. After World War I, Europe lay in ruins. Its cities were damaged, its industries weakened, and its economies exhausted. The United States, however, emerged largely untouched. American factories were intact. Production expanded. Jobs increased. Wages rose. This growth was real. Wealth was being created. Manufacturing surged, and the economy genuinely improved. Americans had reason to feel optimistic. The country felt unstoppable. But this real growth created a dangerous illusion, the belief that prosperity itself was permanent. October 1929. Collapse selling accelerated. On Black Thursday, panic erupted. Brokers were overwhelmed. Tickers fell behind. Prices became meaningless. Margin calls forced selling. Each drop triggered more liquidation. The first cracks appear In September 1929, the market fell, then recovered. The recovery created false confidence. Investors believed the danger had passed. It hadn't. The system becomes fragile. Margin debt reached extreme levels. The entire financial system depended on confidence. Even insiders felt uneasy. When confidence breaks, leverage turns lethal. The chain reaction: brokerage firms failed, banks collapsed, credit disappeared, businesses shut down, jobs vanished. The crash triggered the Great Depression. Reality gets ignored. By 1929, stock prices had tripled. Dividends fell below savings account interest. Stocks made less sense than cash, yet people paid more for them daily. Economists warned that prices had detached from reality. Their warnings were dismissed. Skepticism was seen as weakness.